Mixed market closes in both grain and livestock futures trade. Brian Grady, editor of Pro Farmer, is joining us with analysis. And Brian, we had a lot of mixed trade here today. It looked like some profit taking, but also a lot of reaction here to what was going on with the outside market reaction to the CPI.
Definitely, the macroeconomics took center stage here on Tuesday, and the inflation data came in higher than expected. While the headline number was down a little bit from the previous month, core inflation actually rose, and both of them caught the markets wrong-footed, so to speak. And it's rare that happens, and that's why we saw the big market reaction, though. Major risk off. And the dollar shot sharply to the upside, and it had an influence across the grain and soy markets.
So as far as that risk off, we already knew that we were probably going to see a 75-point basis hike by the Fed in their meeting next week. What do we expect then going forward? Is the market fearful of more aggressive hikes after that?
No, I think that if there's risk short term, it's that we move up 100 basis points or a full percentage point next week with the FOMC meeting. I still anticipate 75 basis points is most likely. But then the market after that anticipates that we'll see 50 basis point hikes in the next two meetings following. And so, the Fed's still going to need to be aggressive. All the inflation data tells us that it's not going away, and everything they've done to this point isn't slowing it down. And as a result, we do need to see a more aggressive Fed, and that will have an influence on risk appetite, I think, across the risk-based assets.
So soybeans saw some profit taking getting cut up and all of that, but do you think that market is going to have to go back up to try to work in this smaller crop size now?
Well, crop size and ending stocks, 200 million bushels of ending stocks for 2022-23, which is projected now. That's pipeline levels. So, we're tight, and we can't afford to tighten it up too much more. So the way you do that is you slow down demand, and USDA had to make some demand cuts, crush exports for the new crop marketing year because of the smaller supply. But we'll see how it all plays out over the course of the next year. But now we're into kind of a demand rationing type of mode. And the only way you do that is through higher prices. That doesn't mean that prices will shoot sharply higher immediately, but it does mean that we probably have limited downside from current levels.
So, like I said, we dip back below the $15 mark. Ultimately, you see us getting back above that, and then where's the next objective technically?
Well, I think you just go in dollar increments, to be honest with you, to the upside. I think we'll see a choppy market, volatile, because while the fundamentals are bullish, we have to keep an eye on the macro situation, and global recession still hangs over the marketplace. The potential for that, the Ukraine-Russia situation. The whole energy situation, which is going on in Europe because of the Russia-Ukraine situation. And so we have a lot of macroeconomic factors that we're also facing in addition to the fundamental factors.
So corn following soybeans down today, but even yesterday it seemed disappointing to see a 76-cent gain in November beans, and corn couldn't get above the $7 mark. Why not?
Well, I think that the corn market, a lot of that is probably going to play out in the cash market. So we know that the crop was hurt this year. What we saw here on Tuesday was that the feeder cattle market really traded sharply lower despite the pullback in the corn market. So the feeder cattle market's telling us that corn prices are headed higher. That may not happen in the futures necessarily. It could happen in the cash market, and where we feed the heaviest number of cattle out in the plains, Nebraska, Kansas, Oklahoma, Texas, that's where we're shortest on supplies, or going to be shortest on supplies for new crop corn. And so, basis is going to come into play. Your cash market's going to come into play. It may not all play out in the futures market as we move over the next 12 months here.
And do small crops get smaller? Do we see subsequent declines in the September or the October report,
I think on corn, yes, definitely. Soybeans, there's some precedent for cuts in September and then to see it higher by the final. So I don't think we can write off the soybean crop yet. Keep in mind, like I said, the biggest reduction for soybeans wasn't necessarily on the yield side of things. It was on acreage. It was a surprise in the acreage cut. That's played out now. So yield actually could creep a little bit higher, I think, with some of these late season rains on soybeans. We anticipate that the corn yield will continue to fall.
And despite the big uptick in the dollar by over a point, we saw wheat market higher. And was that just short covering? Was that all technical or what?
Well, HRW led, and I think that the concern now is that while that area of the country has received some rains recently, especially in those far southern areas, we still have drought, and we have major drought and expanding drought in Kansas, which is the number one HRW producer. So there's still concerns on that front as that crop is starting to be planted. What will the establishment rate be this fall? How will it winter, once it goes dormant? And then what will the conditions be like next spring? And when we look at the longer term forecast, now La Nina may hang around through winter and into early spring. And so that's something that the trade has to keep an eye on as well.
And cattle set back, that was part of the risk off day too?
I think so. Like I mentioned, the feeder cattle led us to the downside despite the weakness in corn. And really the feeder cattle had gotten out to a pretty wide premium to live cattle. The relationship there. So some of that is correction. Some of it's the reality that they won't have as many corn supplies as they move forward over the coming year. And so the feeder cattle market just looked a little bit overpriced. And I think that we corrected some of that. The pressure on live cattle, I think, was somewhat concerns with the macroeconomic situation.
Absolutely. And we have to wait now for the cash trade to bottom. Do you think this week we can see a little bit of an uptick or not?
Oh, possibly. I think that maybe just steady, maybe a little bit weaker, but it wouldn't surprise me if we did firm up the cash. Once the cash market does firm up, I anticipate that we'll see a general firming for quite some time. And by that, I mean not only through the end of the year, but also into 2023 and maybe into 2024 because the numbers are just tightening up that much.
Big up day in the hogs. Are we trying to bottom that market, do you think?
I think so. It was impressive to see hogs do what they did on Tuesday in the face of everything else that was going on macroeconomically and in the outside markets. And so somebody in that market thinks that the cash is close to a bottom and soon to head higher. We've wiped out basically all the discount that the futures held to the cash index. So if we do see the cash index start to turn up, we would see some more buyer interest in the futures, I believe.
All right. Appreciate your time as always. Brian Grady with Pro Farmer.